Do you want to grow and maintain wealth in your family for a lifetime? How about, would you like to find ways to impact generations for years and years past your own lifetime, but not give up the benefits of enjoying things as we go? Well, today's subject matter is going to be on how do we create those moments? How can we impact not only our children's life, but our children's children while enjoying the ride? We want to have confidence in our future stability. We want to be successful in life, but we also want to enjoy it, right? And I want to make sure that this case study not only touches on the essence of what family banking is and how it works, and all those moments that we will have with our children, but also the things it can have way past that. So if you're excited about this as I am, this is the case study for you. Now, we're going to use Dwayne Burnell's book, A Path to Financial Peace of Mind, as our model. He wrote a book that if you haven't read it yet, you can call us, email us. I'd be happy to send you a copy. They're about $20 a piece, or you can go on Amazon and buy it. It's a great read. It gives you a great idea of how these different moments in our life with our children can be impacted by us, how we can collectively with our financial means be able to take advantage of little bitty experiences along the way while growing wealth within the family. There's lots of levels of success, and we're going to cover 4 different ways within this case study. But I'm going to start off with number 1 is by you getting started, by you having an interest to start a policy on a child that would impact their lives and their children's life. That's pretty awesome. That says a lot about you that you'd be willing to do that. So success number 1 is getting started. Success number 2 is going to be in these moments within our child's life of buying cars and sending them to college and then weddings as well. Success number 3 is going to see, well, how does the impact of this financial tool, this life insurance policy that I bought on a child and I've been using to buy things and pay for things through the family banking concept, how does that impact my income? How will it impact the income of my child? And step 4 success, which I didn't put on here because it's really our imagination, because we don't even have those grandchildren, at least in this example, because Dwayne and his wife had an 8-year-old. So they didn't even know what their grandchild would look like. But that's success number 4. Is going to be the impact on that generation through this one case study. We're going to get into the nuts and bolts here, and if you get lost, just press pause and look at the sheet. I kind of try to take these illustrations, as you know, have lots of numbers on them, and try to pare them down to just specifically what we're looking at. Dwayne in his book illustrates buying an insurance policy on his 8-year-old and putting in a little over $1,000 a month. Now, you know this is Dwayne's numbers, because if it would have been mine, it would have been $12,000 even, not $12,533. But this is going to be the base premium that's being paid into this policy on a yearly basis. There's a little bit of nuance that I want to make sure you know, because if you've never bought a policy on someone other than yourself, you need to understand the characters in the play here. The owner is the one who has all the rights to the cash value. They're the ones who get to maintain and access those dollars. They're also the ones who get to dictate who the beneficiary is going to be. So if I'm buying a policy on my child, I can declare myself, my wife, both of us, a charity, whoever I want to as the beneficiary. The insured, even though they get to put money in the policy if they want to, they don't have any rights to the cash value. They're simply, it's on their life. Lastly is the insurance company, and they're going to help us understand who we can insure. Who can we buy an insurance policy on our child? What are the limits or regulations regarding that? And also, they're going to handle the administrative function. So let's look at this specific case study, and I want to talk about one moment. And this first moment in time is buying a car. And I don't know about you, but I remember the first day I got behind my 1978 Chevy K5 Blazer. It had the hard top that would come off. I just remember taking it off. I'm riding down the road. I've got these big mud tires. Yeah, I'm a redneck. And we're just roaring, but the wind's blowing in my hair. And it's just that experience you always remember. Well, in this book, he talks about this one moment in time where as a family, they went to go buy a car with their child. They bought a $15,000 car. And as a couple, they knew that their prudent nature of saving money gave them the ability to help them buy that car for the daughter and not worry about what the bank would say or not say. And you can see in here, they bought a $15,000 car and they made payments back to themselves over 2 years of $715,000. You can see what it was doing with the cash value along the way and what the death benefit was. But the real point in here is the fact that they had saved money somewhere that they could access and use it to buy this car. That they could then make payments back to it. And every payment they made, they knew this was for that first car. This was going to be the car that their daughter will remember for the rest of her life. Well, what's one of the second major moments that our children will have in their teenage years? It's most likely going to be going off to college. And for parents, I haven't personally experienced this yet. My oldest is 12, is sending that kid to college and knowing that they're now becoming an adult and that they're going to be learning things when we're not there. But we still want to impact their lives. And in this example, using this case study, Dwayne used this insurance policy to help impact the life of his daughter through helping pay for those small expenses in college. So you see here, they're using it at age 18 where they took a loan for $5,000 a year for 4 years while the daughter was in college to help supplement the just daily living expenses that existed. They did a couple things here I think is pretty unique too, is that they had their daughter take out a loan for the college tuition. It was $10,000 a year for 4 years. But they wanted her to be in charge. They wanted her to be responsible for the specific aspect, which I feel like is pretty insightful on their part. It taught stewardship. It taught her that, I need to get out of college because the longer I go, the bigger this bill is going to be that I'm going to repay. Not to mention if I don't really get a good degree or something I can get a great job in, it may take me forever to pay this back. And I think that's pretty insightful that they were teaching that, even though they had cash values in this policy that could have paid for that $10,000 student loan expense every year, they chose to wait. And then as a family, they came together, which again, the whole purpose of this is coming together as a family, not being separated in a silo. They come together at age 22 after she's done a great job of getting out of college in 4 years. She's accumulated $40,000 of student loan debt plus the interest, so $45,000. And they say, okay, we're going to use the family's policy here, and we're going to pay off that debt, and you're going to start paying it back. Which, that's the last part in here that they were teaching, was the $1,000 payment that you see going into this back to the insurance company was being made by the daughter in this case. Well, why is that important? Well, because think about all of her peers. Her peers are doing two things. One, they're either getting out and they're paying back the student loans that they took out themselves, or they get out of school, and if they don't have student loans, hopefully they're saving money. Not everybody, though, saves money. They just get out and they start spending. If they have no expenses, every dollar that comes in goes out. That sets a bad precedent, which is not reality for somebody. It's going to create a problem down the road. They didn't want that for their daughter. They knew that you're using the family's money to pay for this college tuition, but they wanted her to start knowing the power of saving money, the power of putting back. So they made this $1,000 a month payment for the daughter. And so if you see this, she's been paying this for 6 years. She doesn't quite get it paid off, almost, because there's another experience about to come into her life, another moment that this daughter is going to experience, and that's a wedding. And we all remember our wedding. We all remember those just fun moments that come along. But as a parent, it can be stressful. It can be stressful to think of, where is all this money going to come from? How is this money going to impact my retirement? Am I going to be able to do the things that we wanted to do and still be able to provide this magical experience for our child. Well, through this policy that they've created, they have enough cash value. I mean, they have more than enough here, $388,000 when she's 29, to be able to pay for this $30,000 wedding. And the idea of using this money and paying it back to themselves, $1,250 a month, allows them to replenish the account, obviously allowing the cash value to continue to grow. That's a pretty neat thing to think about, of how they're using this not only for a car, not only for college, but also for a wedding. And these moments in time that as a family, they're coming together, they're talking about it, they're showing the stewardship of money, and they're showing how this will impact her future. Well, the next moment of this is kind of crucial, and I don't want you to miss this. At this point, the parents have now turned age 65. And we're going to use 65 as the retirement age, and I hope that you'll live and work much longer than that. But when Dwayne created his book, he knew that was the age that everybody thought about, retirement, 65. And so they put that time frame in here to show how they were going to take income from this policy. But also they switch where the daughter had been used to paying back her student loan at about $1,000 a month. They say at this point in time, this is going to be your policy. You're going to be the one, once we're gone, you're going to reap the benefits of this. So instead of us continuing to pay the $1,000 a month for the premium, we're going to make that responsibility yours. But we are going to start taking out this income and our retirement years of $40,000 a year. And we're going to do that for 10 years. So you kind of have this moment where they're handing off this responsibility to the daughter, who now at this point in life is probably pretty set in her career or her family's career and where they are, and $1,000 a month is nothing in the relationship to what they probably should be saving, but this is adding to this. And now the parents have created this instrument that they've used for cars and for college and for weddings, and now they're going to use it, and they're going to be taking income out of this. There's another moment though, another step of success, and that's going to be in the child's life. That's going to be the child seeing how they are going to be using this policy for themselves. So for many years, she paid the $1,000 a month. But when she gets to 65, she's going to quit paying. She's going to now turn this into an income stream for her and her family. And at this point in time, she has over $2 million in the cash value. And the annual withdrawal or annual loan that she can take in cash flow at her age 65 is $125,000 a year. And she does that for 20 years. So for 20 years, she's going to take out $2.5 million. Now, imagine every single moment that she takes out a loan against this policy. She's going to be remembering her parents. She's going to be remembering that this was something that my mom and dad thought of. She's going to remember those three big situations: the day that she bought her first car, the day she went off to college, and the day of her wedding. And she's also going to remember these moments every day too, that she actually takes income from this policy that was created and that was used for the family, that the communication that existed amongst those years, and how this is impacting her life. And if you notice here, when she's 84, she has $3.5 million left that she could pass on to her kids. That's pretty powerful. So if we kind of recap this, we know that they bought a lot of things. They financed the policy to buy cars, and they financed college, and they financed a wedding. But they also used it for income. The daughter was able to take out $2.5 million in her lifetime. Her parents were able to take out $400,000 over a 10-year period of time. And then what they were going to leave in the future is $3.5 million. Something that will create a legacy for generations to come. And Dwayne, in his book, he labels the 5 things that this policy is able to do, and it is that it lasts a lifetime. It's also that, they have the ability to grow within the family. It's a way that they can teach stewardship, which is more important than the money. And lastly, it protects their child's ability to have insurance, because for some people, they were never able to get it because they became uninsurable early on in their life, and they can't protect and they can't provide something after they're gone because they couldn't get it. This was able to do this. One policy was able to do these 4 things. If this is something that just is as passionate for you as it is for me, and you want to figure out how you can implement or how you can start this for your family, it's easy. Create a brainstorming session with us. Just click the button. Just set up a time. We'll get together. I don't know what it looks like, but let's dream together. Let's think of what those moments will be that you want to impact in your children and your children's children's life. Thank you for watching this.